Each borrower is different. Some business owners have a spotless credit record and all the necessary paperwork. Others might not even have documentation as proof of regular income. That's where alt-doc and low-doc loans come into the picture. But how do they differ? Let's take a look. Hey everyone, Louis Dib here from Odin Finance, helping you with all your asset finance needs. If you're self-employed or a small business owner, borrowing money from the bank can be challenging. They require extensive proof of regular income as part of their approval process, which can be problematic if your accountant is still in the process of finalizing your paperwork or your business has undergone some significant recent changes. Foremost, jumping through so many hoops can be pretty stressful. But these days, there are more options available if you look beyond traditional bank lenders. And that's what we're going to talk about in today's video. So make sure to stick around and take some notes because you could be on your way to be buying that new business asset quicker than you think. Before we start, you should know that this video must not be construed as professional or financial advice. In particular, you should seek independent financial guidance from a professional who can advise you on the best ways to proceed in your personal circumstances. When you start exploring alternative loan options, you may come across a few terms that make you scratch your head. What exactly are alt-doc and low-doc loans? Unfortunately, some lenders and brokers like to use alt-doc and low-doc interchangeably, so it can be confusing to know the difference. So let me break it down for you. Alt-doc loans or alternative documentations loans is when a lender allows you to provide alternative documentation to support your application rather than the typical financial breakdown and tax return papers. This is a great option if you can verify your income, but not exactly how mainstream lenders generally prefer it. To qualify for an alt-doc loan, you may only need to submit your business bank statement and your business activity statements. Each lender will have different requirements, but generally you can expect at least 6 months worth of business bank statements and BAS from the last 2 quarters. Some lenders will also check your ATO portals to make sure your tax payments are up to date. On the other hand, low documentation or low-doc loans are loans that require very little documentation or even no documentation at all. To be eligible for low-doc loans, different lenders have different criteria that customers must meet. For example, you might only have to show your ABN and prove that you've been trading for at least 2 years. Other lenders might want a finance reference and a deposit. It all depends on their requirements and what you can offer. There is a common misconception that low-doc loans come with a higher interest rate due to the supposed risk. But that isn't necessarily the case, especially with the major banks. If you can tick all their boxes, there is no reason for them to consider you higher risk than someone who's able to provide full documentation. But I will say that we have seen that lenders will generally favor alt-doc loans when it comes to the amount of money you want to borrow. In other words, certain lenders will give you a higher finance amount if you can provide bank statements or BAS statements. So there you have it, a simple breakdown of alt-doc and low-doc loans. But of course, different loan products need different levels of supporting documentation. So it's good to chat with the finance broker about your options. We'll go through the income verification documents you have, talk to you about what the options are, and work with you to find the lender that meets your needs. So if you'd like advice on your options, get in touch with us at Odin Finance. Also remember to hit the subscribe button and stay tuned for more tips about commercial loans and asset finance to help with your business growth. See you next time.